Hey everyone, welcome to Trading as a Revenue Stream. I'm Imran Lakha from Options Insight. I founded Options Insight about 7 years ago, and I used to be a trader in the city for nearly 20 years. So I one day decided, okay, enough is enough. Let's try a business. And I've always loved teaching. So I thought, why not teach the thing that I've learned for like nearly 20 years and try and make a difference in people's lives, basically. So that was the idea. Now, there's various things that I do as part of this business. I do podcasts. I have online courses. I run a trading community. But through meeting a lot of people over the last few years, in London especially, whenever I tell people I'm a trading educator, they're like, oh, I'd love to learn how to do that. And so I was like, you know what, why don't I just do a talk like this to make it a bit more accessible, go through some of the basics, and that will hopefully help people along that journey, basically. So it's a Q&A session, so feel free to ask questions along the way. Don't be scared to interrupt me. The idea is that you learn as much as you possibly can in the next hour and a half or so, and let's get going. So first of all, what is trading? So do any of you have any experience in trading or investing or anything like that? Yeah? Okay, so what sort of stuff have you done?
I put money into stock, but I just don't do anything though.
Okay.
For money.
So that's called passive investing, yeah? That's what you've done. Okay, cool. Anyone else done anything?
I've done that as well.
You've done that as well?
Practice on Forex trading.
Forex trading, okay, yep. There's a lot of people out there on Instagram saying that you can get rich quick doing Forex.
I don't.
With their Lamborghinis and stuff. But yeah, it's not really the reality. Anyone else touched anything in trading? Crypto? Anyone dabbled in crypto? Yeah? And how's that gone?
If I did it flat, I would be doing very well.
Okay.
I think one of those things.
Yeah, okay. So it's a little lottery ticket and then it went up a lot and then it went down a lot. Well, did you get into any of the meme stocks?
Yeah.
Yeah, okay. That's where you went wrong, right? Because those can definitely go up a lot, but the problem is there's no tangible underlying value. So that's the risk, right? So anyway, so what I've done is I've kind of compared, well, first of all, what is trading? What's the definition of trading? So buying and selling assets. They could be things like stocks, Forex, as you mentioned, commodities like gold or silver or crypto, right? And the idea is you're trying to make money by buying and selling these things. And that involves taking risk. And it also involves timing a little bit, right? Because if you're not passively just putting money in and leaving it for ages, and you're actually trying to get in and out and actually capture some profit, then it does involve learning how to time the market a little bit and understand how the market moves. Now, obviously, the opposite of trading is just saving. Okay, so, preserving your capital, putting it into a low risk account that gives you steady growth, often just sort of fixed income, like the interest you would get in a bank. That is your alternative, right? So if you have some money, you can either just stick it in a bank and save it, or you can try and trade it or invest it, basically, right? Now, obviously, you've got to be willing to take a bit more risk if you're going to trade or invest. So why might you not be satisfied in the world we live in with just sticking your money in savings accounts? What is the motivation to think about investing and trading your money rather than just parking it in a bank? Inflation. So inflation, what we also sometimes call inflation is monetary debasement, right? So what that means is, because if you look at the inflation numbers out there, right, that's like the CPI, for example, consumer price index or whatever, they might actually be quite benign. They might be like 2-3%, something like that. So you might not think that there's a major inflation problem. But the problem is all the stuff you want to buy with your money, like houses or stocks or whatever it is, they keep going up. Like stocks go up 10, 15% a year. And if you don't invest, those are just getting more expensive every single year, right? So your purchasing power, if you just leave money in the bank, is eroding every single year. And the reason that's happening is because governments around the world are in so much debt that they just print more and more money every single year. And the more money there is sloshing around, that money finds its way into the price of assets that people are all trying to buy, and those assets go up in price. And if you don't get yourself on that train, if you don't invest at all, then you just get left behind with your money in the bank, which now buys you less and less every single year, right? So that's the problem that we're trying to solve, right? We have to learn to invest. We have to learn to maybe even trade if we're willing to take a bit of risk. Because if we don't, the purchasing power of our money is getting eroded and eroded every single year. That's what you call the monetary debasement that's going on. Okay? Does that make sense? Any questions around that? Okay, cool. So now let's talk about the easiest part, right? Long-term passive investing, right? That's what you mentioned that some of you guys already do. That is a bit of a no-brainer, okay? You kind of have to do that. And that just involves holding assets for many years. Any spare money you have, keep some available for emergencies, but anything that you don't need for emergencies, you start slowly putting it into things like the S&P 500, the NASDAQ, whatever it may be. Now, the good thing about that is it's quite low stress. If you look at how much over the long term that makes you, it's about 8 to 10% a year historically on the S&P, okay? And it's very suitable and easy for beginners. You just literally, you don't have to think about it every month or every few months. You just stick a little bit of money in a passive index fund, and you just keep accumulating that over time, right? But you've got to get it into your head that there will be times where the market goes down. And so you might have invested some money and then 3 months later it's down 20%. That's actually a gift for you to buy more, yeah? Because you're thinking about it on a long-term perspective. If you're going 5, 10, 20 years into the future, these things will keep going up because money will continue to get printed and these assets will continue to get bought. And over hundreds of years of history, stocks only kind of go up over the long term. So as long as you don't need to sell in a downturn, as long as you don't put everything in that you're going to be in trouble and you're going to have to liquidate, then you can continue to accumulate in this way. And this long-term passive strategy tends to do quite well, right? And it protects you against that monetary debasement that we've been talking about, okay? So only invest what you don't need in the short term, right? That's very important, okay? Now, I've mentioned asset allocation up there as well, right? So you could just do an S&P 500 index fund, but if you want to be a little bit more secure and a little bit more safe, what you can do is you can split your money into different things, like some in stocks, some in gold, some in bonds, something like that. And there are funds and there are ETFs available in all those assets for you to have something a bit more diversified than just putting it all in the S&P, basically, okay? And so people like me who have been in the market, who understand like some of the drivers of the market, we call them macro drivers, like economic growth, interest rates, inflation, where those things are headed. If we have half a decent idea of where those things are headed, then we can kind of figure out what might be a better allocation in stocks, gold, bonds, etc. So, for example, when COVID happened back in 2020, I had some stocks, I had some bonds, I had some gold. I didn't have too much gold at the time, but when I saw what the reaction was to COVID and how they were just printing money like crazy, right, and increasing the debt by trillions, I was like, well, gold's a no-brainer. So I allocated a lot of cash that I had into gold because it made sense to me rationally that gold would do particularly well looking forward, right? Obviously, gold's had an amazing year this year, right? But the point is, you can make those allocation decisions and you can kind of shift your pot around and say, you know what, right now stocks are down 30%. I've got a chunk of cash that I've been on the sidelines. I can put it in here because, you know, I'll be opportunistic that stocks have dropped 30% and, you know, over the long run, they will likely recover. So these are the kind of moves that you can make in a long-term passive portfolio. So this isn't really trading. It's kind of a bit more like investing or even a bit more active investing. But it's a good starting point for you to kind of start to learn how the assets move and what environment would be good for gold, what environment would be good for stocks, tech stocks, healthcare stocks, whatever it may be. And you can start to learn that basically. Okay? So that's probably the first thing. And even myself, even though I've traded for over 20 years, most of my money is this type of investing. So I don't allocate most of my money to short-term trading. I allocate most of it to long-term investing, right? So I think that's a clear takeaway. Even someone with 20 years experience trades with a relatively small part of their pot And the big part of their pot is in this style of investing. Okay. So then apart from the passive, you've got active trading strategies. So a couple of different things to think about here. This is not all encompassing, but the main types of active trading are swing trading and day trading. So swing trading is a bit longer holding period, maybe days or weeks. And the idea is you're trying to capitalize on short-term price swings based on trends, usually looking at technical analysis. A lot of the times there's a lot of charts and candlesticks and things like that, supports and resistance levels. Are you familiar with any of these things that I'm talking about?
Yep.
Yeah. So we could bring a chart up, for example. Okay. So here we've got a chart, for example. In fact, I was showing Mez this chart earlier. So, here you've got a candlestick chart. You can look at different time frames, but this particular one is a daily. And the idea is when you look at a chart, I mean, people look at charts and call them squiggly lines, and it's like, well, how can you predict where this thing's going to go, right? And the reality is you can't, right? But what a chart shows you is it kind of shows you the human psychology of people who trade that asset put on a map, basically. Okay. And the thing we know about human psychology is you have fear and greed, right? And fear and greed kind of appears over time and in repeatable patterns, and it kind of appears in waves, basically. Okay. And often you have assets that trend for long periods of time. Okay. So, I'm sure you're all aware of trend following strategies or whatever, right? You might have heard that term trend following, right? So people look at charts to identify the trend of an asset. Is it trending up? Is it trending down? And then they will use some analysis of that chart to try and find entry points into that trend, right? So for an example here would be, this is uranium, okay? Just for an example. So uranium's clearly had a big up move in the last few months. So if you think this thing is trending up after such an aggressive move from, say, April to July, and then it has this pullback, you're basically saying, okay, I believe the trend is higher. I'm looking for an entry point to get into that trend. And basically I'm not going to go into all the different types of analysis you can do to figure out where you want to get in, but on a pullback, you're going to be looking for entry points, right? And then if you had managed to buy that pullback there, then you're in that uptrend, and that uptrend is continuing, basically. Okay. There will also be times where you think a trend is exhausted. So there'll be certain types of indicators or things that you're looking for to say, you know what, it's been in a trend for a while. I'm starting to see things that are showing me that trend is running out of steam. So if I'm in this asset, I want to be scaling out of it, getting out of some bit. Maybe I want to be doing things to protect it going down. And we will talk about that a bit when we talk about options and the kind of protection trades that you could maybe do. Yeah. Any questions on that, on charts and things like that? I'm sure there must be loads, but is this something that you guys look at or have ever looked at? No?
Yeah, a bit. So wait,
do they scare you, these charts?
So what, what's the market cap? What's the, how the length of the candles telling something, right?
Okay, so what does a candle, I'll give you the anatomy of a candle, right? So what does a candle mean? So if it's a green candle, it means it went up in that time frame. So here it's a daily chart. So each candle represents a day, okay? I can switch that to an hour, and now it looks very different, okay? So that's like all the hours. Every candle's worth an hour. But basically, the body of the candle, i.e. the fat part, right? So see that green one? From there to there, that if it's green, it means it went up, right? So that means that price there is where it started, that hour, and that price there is where it ended the hour, okay? So the body is the open and close of the period, okay? The wick, which is see this thing's got a wick there and a wick there. Those are the highs and lows within that period, okay? So in that red one there, that opened there, it closed there, but in the hour, it did touch as high as there, and it also touched as low as there, basically.
Yeah, so it shows volatility.
Shows exactly. So the wicks show you how volatile it was, the high and low, but the body is the open of that hour, and the close of the hour. Yeah. And if it's green, it meant it went up. If it's red, it went down. Okay. So that's how candlesticks work. Right now, I'm not a big believer in candlestick patterns. There's all these millions of candlestick patterns and stuff that people analyze. I'm not saying that they're wrong or anything. It's just not an expertise that I've trained in and I particularly use. The thing I look for is I do look for trends. I look for trend exhaustion. I've got certain indicators that I look at for that. And I look for waves, right? I'm a big fan of looking for waves because it allows me to basically get a feel for when something's gone, something's gone really crazy in one direction and it's correcting, and I'll be ready for the next wave that is coming, basically, right? And I'm kind of using that as an entry point. All right, so that's kind of charting and tools. So obviously this is a lot more hands-on than passive investing, right? But obviously if you get it right, there's a hell of a lot more return that you can make in this style of trading. And then day trading is just that squared, right? Day trading is I'm not holding it for days or weeks. I'm in and out on the same day. So you'll be looking at maybe slightly different indicators when you're doing day trading. You'll be looking at volume, like how much volume's trading at each price to get a gauge for where it might go in the next hour or something like that. Again, it's a very, very active, very labor-intensive thing, day trading. It's not something I particularly do. I do some options day trading, which I can talk about a little bit later on. But again, it requires you to have a bit of time and energy to really stare at the market all day long, right? Which may not be what you're after, right? Especially if you've got another job or another business or whatever, right? So, but it is something people do. It's also something that people obviously use bots to do as well. So a lot of people employ bots to do day trading. A lot of people are building that out now with AI and stuff, right? So there's various providers of trading bots, which you might want to, experiment with and investigate. It's not something I use yet, but it's not something I'm against. But I think you've got to be careful about who you go with on that, right? You kind of want to kick the tires and test it out before just blindly following some of these things, or even like giving your money to any of these people. Yeah. And then on trading, really, the biggest thing in trading, in shorter term active trading, is risk management, right? If you don't have strict stop losses and you don't size your positions correctly, then you will be like 90% of other traders and you'll lose all your money, basically, right? You probably heard that stat, 90% of all traders lose money, right? Or lose all their money, right? It's true because they don't understand stop losses and sizing. That's the main reason. Yeah.
Is it about they don't understand it or they just get emotional?
Well, it's kind of the same thing, right? They don't implement strict risk management and sizing because they don't treat it like a professional. They treat it like a gamble, basically, right? So if you go into trading and think it's a gamble and the money doesn't matter, and if it goes to zero, I don't care, but if I 10x it, then great, they'd expect to lose it all, basically, right? Because when you go into a casino, right, you expect to lose it all, don't you, right? So if you approach trading like a casino, you should also expect to lose it all, right? But if you approach it like a business, it's a bit different, right?
Yeah, what's conservative sizing?
Conservative sizing just means you don't go balls in with all your money.
Like being...
Yeah, so it's being sensible. So it's like saying, okay, let's say I've got $1,000. Let's say I've got $1,000 to invest, yeah? How much am I going to risk of that $1,000? How much? Say I've got $1,000 for trading, not for passive investing. But let's say I've got $1,000 that I'm willing to play with for trading. Okay, that's my capital. How much of that $1,000 are you going to risk per trade? Is it going to be half of it? Is it going to be a quarter of it? Is it going to be a tenth of it? Is it going to be 5% of it? The conservative sizing would be no more than £50 to £100 out of $1,000 for a single trade, right? So the most you can lose on a single trade shouldn't be more than like 10% of your pot, right? But non-conservative sizing would be just put the whole thing on one trade, right? And to try and double it or triple it, right? So if you approach it like that, chances are it's going to go pop pretty quickly.
Is that sort of where like lot sizes come into it, like when you're like...
Yeah, it's a lot. Yeah, lot sizes are just like when you trade any trading instrument, there'll be like a minimum size you can trade, right? So like one lot will be the minimum, let's say. Okay, now the truth is when we're moving to a crypto world or blockchain and stuff, everything's going to become fractionalized, right? So actually, there won't really be lot sizes. You'll be able to trade 0.001 of a share or something if you really want to.
Yeah.
So yeah, so that's changing. But generally, most platforms will have like a minimum lot size that you can trade. And so you got to make sure you've got enough in your account to be able to do that, and that it isn't too big a portion of your account. Otherwise, you don't have enough to really trade, right? But generally, like, I think you can definitely start trading with quite a small amount of money. You don't need like tens of thousands already to trade. You just start small, learn your craft, establish what we call an edge, right? An edge is where you are statistically proving to yourself that you make money more than you lose money, right? And on day one, you're not going to have any edge, right? There's millions of people in the world who are trading and have been doing it for years. And even a lot of them don't have any edge. So then what makes you think you on day one are going to have a load of edge, right? So you got to learn techniques. You've got to understand your own psychology. You got to put in the work to create some edge for yourself in a way that you can manage in your lifestyle and the way your brain works and what you like to do. And then you can figure out, okay, and the way you figure out your edge is through journaling as well, right? You have to, like, when you do your trades, you can't just like forget about them. You have to actually analyze, why did I do the trade? How did it go? How did I feel? Did I stick to my plan? Did I get all emotional and mess it up? What did I do, right? And then as you look back at your journal, you'll start to see, okay, I'm not very good at this style of trading. I'm better at this style of trading. This style of trading makes me like go crazy and like lose all my control. Whereas this is much more in line with my personality. And so this is the type of trading I should do, right? Maybe day trading doesn't suit you, but maybe swing trading does, right? These are the kind of things you'll figure out through journaling and analyzing your own behavior, basically, right? But it's quite important. Yeah. Okay, so that's, and then, we talk a little bit about, the type of assets that you can trade. So, stocks versus Forex. I could also say, or crypto or commodities. Do you prefer, buying shares in a company like Apple or Tesla? Because you can actually see what products they offer. You can have a view about their business, whether it's good or bad, whether they're going to make more money in the future or not. You can have an opinion about that, right? It's not that hard to have an opinion about whether you think Tesla is going to continue to do well and take over the world or not, right? Whereas you might struggle to have a view on whether the pound is going to go up or down in the next 6 months, right? But some people actually won't care about Tesla, Apple, all these things. And they'll say, actually, I'm interested in geopolitics. I'm interested in like macroeconomic trends and kind of how countries are doing versus each other. And actually the way that plays out is in currency prices or bond prices or whatever, right? Generally, I think the average person kind of enjoys trading stocks a bit more because they can kind of, buy into the idea of like, an Nvidia or whatever and what they're doing in the AI space and stuff like that. It's a bit more exciting and you can kind of, connect with it more, I think, right? Macro is a bit harder to connect with for the average person, I'd say, right? And then on the macro side, let's say you don't want to pick individual companies or whatever. We talked about index tracking. So you could trade like the S&P or the FTSE index and just take a position on those. And that is a macro view. But that's like saying, I just think the stock market's going to go up or down, basically, right? So not individual stocks, but the overall market's going to go up or down. And that's what, index trading. So that is a macro type of trading, but it still is stocks, but it's just the whole market as one that you're trading, basically. Yeah. And then the other thing I put is event trading, which is kind of an interesting type of trading as well. So, day to day, stocks go up and down for whatever reason, like there's more buyers and sellers or whatever. But, in stocks, you get a quarterly earnings announcements, right? Every quarter, they have to announce their earnings. And the whole street, when I say the whole street, I mean the whole industry is like figuring out what their earnings are likely to be, putting estimates out, and then they come and either beat those estimates or they miss those estimates, and then the stock goes crazy and has a big old move. I mean, recently it was crazy. Like Oracle had a earnings announcement and the stock was up 40% that day for a company that's not a small company, right? It was crazy move for earnings, right? So you can get some really big moves on earnings. And if you manage to, for whatever reason, call the earnings correctly, if you're good at that, right? Or if you have any edge in that, you can make a ton of money, right? Now, me personally, I don't have any real edge in calling the earnings, right? I don't really analyze these companies to the level where I could really guess whether they're going to beat or miss. I can have a rough idea based on, for example, if there's like a load of companies that have reported in the consumer space, for example, Walmart or whatever, and they miss earnings. And then a month later, you've got another kind of retail type stock like Costco that has got earnings. Then I could maybe say, okay, because these other retailers missed, it's probably not the best environment for the consumer. So maybe Costco might miss. But that's not me doing any amazing analysis. So then why am I going to have any edge there? The whole street has seen that. The whole market has seen that Walmart missed. They're probably having a similar opinion to me. So again, I can think that I've rationally thought about earnings and I've got a good idea. But unless I do some real hardcore analysis, it's probably not going to give me any edge versus the rest of the market, basically, right? Yeah.
With these companies, is it all sort of long day swing trading, or can you like scalp these kind of companies as well?
Scalp just means intraday day trading. Yeah, right. Of course you can. Yeah, 100% you can. But it's just scalping is like
Sitting there all day.
And it's kind of like, again, what is the edge? Like, what is going to tell you that stock is going to go up or down in the next hour, right? Like, what's going to give you an advantage in guessing that right, compared to everyone else in the market? There's all these algos that are trading. There's all these guys sitting in banks that are getting calls from big hedge funds, pension funds saying, buy me this stock, sell me this stock. They see the flow. That's called flow, right? When clients are buying and selling stuff, that's flow. If you're at a bank, you're in the flow. You've got that information. And even you're probably struggling to guess where the stock's going to go in the next half hour. So us lot sitting at home trying to figure it out, scalping stocks, I just don't think we've got edge, right? And this is why options are so important, because with options, we can have some edge, right? But we don't really have a ton of edge in just deciding whether the stock's going to go up or down in the next hour, right? Because I'd say even the pros don't have that much edge in that, right? So anyway, earnings announcement could be these huge triggers. Economic data prints, things like non-farm payrolls, which are due on Friday. Every month, US jobs data comes out. Everyone goes crazy. It moves the market a little bit, not that much, but in the macro world, it's an event that everyone cares about every month. And, the reason why people care about that is that if the jobs data is particularly good or bad, or the trend in the jobs data is up or down, that impacts what central banks are going to do. And then that impacts like what the market does, basically. So everyone's trying to second guess what policy is going to come on the back of trends in the labor market, trends in inflation, that sort of thing. Okay. So these are different styles, right? So you got to fight, again, in trading, you got to find, what am I interested in? Like if you couldn't care less about tracking the jobs data and what broad economies are doing, and it doesn't really interest you, it's not really what you should be trading, right? Whereas if you do have, like, let's say you are interested in AI or whatever, and you want to track like a handful of tech stocks, and you like watching those stocks and where they're going and how they're moving, then maybe that's more the sort of things that you should be trading. Yeah. Just got to find what interests you. And the only way you can do that is by actually watching them and then getting a feel for them, and then you'll learn that about yourself, right? All right. So that's trading. We could take a break if you want, or we can crack on with what options are. Up to you. Options? Okay.
Stop again. Sorry.
Minor.
One of you.
So I'm gonna restart that bit. Just be like, okay, so what are options? No, and cut that bit out.
I think it's not realistic to pass the microphone. I feel like I'm just gonna keep it here. Just in case you push out.
I don't know. It's hard to know. I mean, maybe half hourish, something like that. Cool. Okay. Okay, cool. Thank you. So how was that? Does that make sense so far? Okay, cool. Yep. All right. Ready? Yep. All right. So the next big question is, what the hell are options? Right? Because that's the thing that I teach. That's the thing that I've done for over 20 years. And it is a thing that I genuinely believe if you learn about it, it will help you find some edge in trading, right? probably a lot more likely to find edge in trading options than figuring out where Apple stock's going to go in the next 2 hours. Okay? So, anyone know what option is? No. All right, cool. So think about an option like a way of reserving a stock. Okay? So we said stocks like Apple, Tesla, whatever, you could buy them. Okay? And it cost you a certain amount of money for a certain number of shares. Okay? But if I say, no, I don't want to buy Apple, but I want to buy an option on Apple, I want to buy the right to buy Apple at some point between now and a future date. That is an option. So think of it like you can buy a ticket to a concert, but you don't have to show up and actually go to the concert. But you have to pay the price of the ticket, right? Okay? So you can pay a small amount of money to reserve the right to buy a stock at a certain price, okay? But that's not the same as buying the stock itself, because it's just giving you the chance to buy the stock if you want to in the future, okay? That's what an option is, okay? It's the right to buy or sell, because there's two types of options. There's the option to buy, which is a call option, the right to buy, or a put option, which is the right to sell, okay? So you're spending a little bit of money, which we call the premium, if you're a buyer, okay? You don't have to buy options, you can sell them as well. But from a buyer's perspective, I could buy a call option or I can buy a put option. I have to give you what we call the premium to buy that. And that now gives me the right to buy or sell that asset, okay? Now, the asset can be a stock, it could be an index like the S&P, it can be commodity like gold, or it can be currency or whatever, a crypto like Bitcoin. You can have options on all these things, right? And that's what you call the underlying asset on the option, okay? And then every option has got these two key things. The strike price, which is the price that you have the right to either buy or sell it at. And it has an expiration date, right? So like I said, with the ticket, if you don't show up on the date of the concert, then tomorrow it's not going to matter because it's done. It's expired, yeah? Same thing with an option. You could buy an option that expires this week. You could buy an option that expires in 3 months, 12 months. But once that expiry date is gone, the option's dead. So it's not worth anything to you after that, okay? Any questions? Does that make sense? Yeah.
Why isn't it like trigger or activate straight away? Is it that because you're waiting for a specific price to get the end of the trade?
Well, we say activate when you've got the option to buy a stock, for example, okay? Right? So really it's about when you decide to activate. If you buy that option to buy a stock, right? You don't have to buy it. That's the point. You've got the right to buy it. So you've got no need to make the decision yet, right? You can make the decision closer to expiry, or actually on expiry is when you're going to make your decision to either exercise your right to buy it or let the option die, okay? Or we'll talk a bit more about why you would let it die or whatever in a minute, okay? But that's just the basic terms, the key terms, right? Call option, put option, yep.
I think you might go into it, but I was really confused as to when you know the price, like what determines the price you buy it at. So I know you have the price that catches the option, but then
Is that you mean the premium?
the cost to buy?
The cost of the option is that.
That's fine, but what price would you buy the
asset, the underlying?
Yeah.
That's the strike price.
right?
And you can buy options with lots of different strikes. You have to choose. You have to choose what the strike is of the option you want to buy. Okay. So every asset, like every stock, has got what we call an options chain. Okay. Right. In fact, I can show you an options chain for maybe Bitcoin or something. Right. Let me bring this up. Have I got it here? Cool. So this is actually right. So this is what you call options chain. Okay. And what that shows us is Bitcoin's trading at something like 113,000, okay? And this shows us that this shows us the price of calls and puts of all these different strikes, okay? So these are the prices where you can buy or sell this thing, and look at every single strike. Every 1,000 points there's a strike, yeah? So you can say, you can decide which option do I care about? Do I care about the option with that strike price, that strike price? So that's the point, right? Like, options give you options, basically, right?
Here's what point did you choose?
Well, that's a whole new ball game. Deciding that. Let's understand the mechanics of an option, how it works. Then we can talk a little bit about why you might choose a strike or whatever. Yeah. Any other questions so far? All right. So those are the key terms. Okay. I really understand these. That's why they are key terms. Yeah. Okay. Next thing is, all right, how does it work? So the buyer pays a premium. All right. Why do they pay the premium? Because it's potentially a big payoff, which I'll show you in a minute, to owning an option. Okay. Now, if you're the seller of that option, for every buyer, there's got to be a seller, right? If there's a buyer, someone has to sell it to you, right? If you're going to buy it. So why is the seller selling an option? They're selling the option because they get to collect the premium, right? It's kind of like selling insurance, right? If I collect the premium and nothing happens, then that was just money I made. It's almost like free money, okay? It's not really free because there's a risk associated with it. But it's kind of like selling insurance if you're selling options, okay? Because you're taking the risk that the buyer will exercise that option on you, basically, which is not really what you want. Okay. Pros and cons. So now we're going to talk about why people would trade, why people would use options. Okay. And the first main use is to get leverage. Who knows what leverage means? What does that mean?
Opportunity?
No.
Do like the best deal?
No. So leverage is like, kind of, think of it like you're trying to get as much bang for your buck as possible, basically, right? So let's say you haven't got loads and loads of capital, okay, right? So how can you put your money to work so that it can make you the most amount possible, right? So that's leverage. Leverage is like getting more, amplifying the potential returns of what my money can make me, okay? And the thing about options is they give you safe leverage, okay? And we're gonna talk for an example. So let's say we've got Tesla, okay? So Tesla stock's trading at $440 right now, okay? So if I was to buy, how much would 100 shares of Tesla cost me in money? $44,000. You got a spare 44 grand lying around? Okay, exactly. So not that many people have got a spare 44 grand lying around. So this is the problem. For me to buy 100 shares of Tesla, I might not have the capital to be able to do that. Okay. If I did buy it, that's what my payoff would look like. Okay. If it goes up, I'll make money. If it goes down, I'll lose money. It's a straight line. It's a 45-degree line. If it goes up by 10%, I'll make 10% on the 44 grand. If it goes down 10%, I'll lose 10% on the 44 grand. Okay? Pretty simple. Now, if I didn't buy the shares, but I bought an option that allowed me to buy the shares at 440, what do you think that line would look like?
Would it be like a higher gradient?
Okay. Well, first of all, if the stock drops to 320, right, buying the stock, I'd be down over 10 grand. If I bought the option, would I be down that 10 grand? Because I wouldn't exercise the option, because I wouldn't buy the stock at 440, would I? Because it's trading at 360 and 340. So does that mean this negative line, am I going to experience that loss? If the stock goes down, am I going to lose any money?
No.
I'm not going to lose.
So you will. You lose when you cater for the option.
I'll lose the premium, right? So I won't lose any money because of the stock going down, because I just won't buy the stock. But, so it's a flat line like this, but because I paid premium for that, I will lose the premium, right? What about on the upside? Will I have this diagonal line? Because if it goes up, will I exercise the right to buy the stock? Will I buy the stock? I will, right? If the stock goes up to 500, I'm obviously going to buy it at 440, where I've got the right to buy it, so I'm going to buy it, right? So I get access to the upside. I don't have the downside, yeah? So when I buy a call option, the payoff looks like this. Yeah? So we obviously lose the premium, which is this fixed distance here, right? But on the upside, we do participate and we make money in the stock. Now, if I bought 100 shares, it would have cost me 44 grand, right? But if I buy this option that expires in a month, it's going to cost me, let's make it the 440 strike. It's going to cost me 3,300, which is less than 10% of what I would have had to pay to buy the shares. Okay. And that gives me the right to buy 100 shares. I don't actually buy them, but because I have the right to buy them, if the stock rallies, then I have a potential payoff, basically.
Does your payout stop at the 47 month? Is that, 1 month?
Does the payoff what?
Does it stop where the blue line is because you have to?
No, it doesn't. I'm not sure why that blue line's there right now, to be honest. So we just go back to this. Here you go. That's better. That was some weird prediction thing that it's doing. So today, that option cost 3,300, right? And if the stock went up to 500, I would be up 4 grand, okay? Which is over 100% of my money. But if I'm investing 3 grand and I make 4 grand profit, that's more than 100% return on my money, right? That's leverage, right? Whereas if I bought 44 grand of the stock and the stock had gone up to 500, it's about a 15% move. I would have made a chunk of money, but percentage-wise, I would have only made 15% on the capital that I invested, right? But here, I'm making more than 100% on the capital invested because of the leverage that the option's giving me, yeah? And the more, right, does that make sense? That's what that leverage is, right? The capital can multiply, right, much faster for the stock not actually doing that much, right, 10, 15%.
It's like a percentage.
So what's not so obviously the leverage is great, right? But what's not good about this? What's the risk here? What's not so great about owning this option?
It's still like basically 10 times the actual fee.
Sure.
You still have to pay it.
Yeah, you still got to pay it. You can't get away from that. If you're going to buy an option, you've got to pay the premium. That's not actually change. But I guess the point is, let's compare it to owning a stock, right? What if you buy the stock and the stock just doesn't go anywhere? You're not going to make any money, but you're not going to lose any money, right? If you buy this option and it goes nowhere, and remember this option expires in a month, so in a month's time, it's very possible the stock's still here, right? What happens to your money? What happens to your 3 grand? Goodbye, right? You lose it all, right? So as we progress through time, look what happens to the line. The line drops and you lose all your money, yeah? So you're getting leverage, but that's because your money is at risk, yeah? Because that money is decaying away through time. And if you don't get a move in the stock, goodbye your 3 grand, yeah? So nothing comes for free, basically, right? So to get leverage to your capital, you have to be willing to take the risk that this capital might disappear pretty fast if nothing happens, right? So that's the flip side of owning options, which actually makes owning options a pretty hard game, yeah? Owning options, when that time decay is working against you, where the option, if the move you're looking for doesn't happen quickly enough, you could get eaten alive by that time passing, right? And so if you invest too much money into these options thinking I'm going to make loads of money and get loads of leverage, that money could disappear just as fast.
Wait, what happens with the time decay?
It's just the value goes down every single
Is
day.
that because it's external factors?
There's been those because by nature of the option has less time to make you money, right? The reason why the option has value in the first place is because there's a chance it works. There's a chance that it makes you a ton of money, right? But every day that goes by and the stock hasn't moved, there's less chance it's going to make you money, right? So the amount of value of the option is a function of how much time is on it, and which is why. So this is the 31st of October. If I extend that expiry to November, that option, same strike option, is worth 4,300. The December option is worth 5,000. The Jan option is worth 6,000. So the longer you go, the more value the option has. So then when you buy an option and then it becomes shorter through the passage of time, it becomes worth less,
Right. Because when you sell it off, it is high, like it's got less tolerance and miles.
Yeah, no one's going to pay as much premium for a shorter dated option, right? Because you're paying for the time, right? There's a value to the time. And if you're giving me less time for my option to pay out, then I'm giving you less premium, basically. Yeah? Does that make sense?
I had another question. How common is it practice for like you are
Like crypto players that enter the market.
Crypto options are really only liquid in terms of they trade a lot in Bitcoin and Ethereum. Yeah? Like even Solana's not amazing.
I play.
Yeah? So I think it will come through time. But really, the depth of liquidity is all in Bitcoin and Ethereum. So, anyways, do we understand now what the payoff, how different that is to just owning a stock, right? When you own a stock, you're trading a line, a straight line, right? When you trade an option, you're trading this curve, okay?
Parabolic, is that parabolic?
Well, it's not really parabolic because it's got this kind of, it ends up being a 45-degree line there. It doesn't keep going up. A parabola just keeps going up and up and up, right? Yeah? So it's not parabolic, but it's curved. It's convex is probably the term that I would use, right? So that's the game, right? So when you trade options, you get leverage. And, the flip side of that leverage is that you pay time decay. That's your risk, right? Your premium can evaporate on your option, okay? So then the other use, and probably the most common use, I guess, is income, right? So what if I own the stock? So what if I'm long Tesla? Tesla's trading at 440. When you're long the stock, that means you own the stock, okay? And let's say I want to earn some extra income against my Tesla stock. What could I do to earn some income using options? How could I collect some extra money?
Not touching your stock, you're sharing what you already have, or touching what you have.
Not touching.
Yeah. But you still have some capital to pay it.
Well, I own the stock, right? If I'm comfortable selling the stock 10% higher, let's say, is there something I could do with options?
Change the trigger hit.
Well, at the moment, there's no option here, right? This is just the stock position, right? Long stock. I'm long Tesla. Let's say I bought this stock at 440. So this is what my payoff looks like. I'm long the stock. So I'm asking, what could I do? What option trade could I do against the fact that I own the stock?
They'd put an option that bought me.
Yes, I could sell. What could I sell? If I own the stock, right? Remember, a call option was the right to buy.
Yeah.
Yeah.
Does it mean that you'll sell your profit if it, for whatever that person, for whatever metric, for however it moves it in?
Yeah, so let's back up, right? What's a call option? Call option is the right to buy the stock, okay? We talked about a call option that was struck here at 440, which is where the market is currently, right? But you can remember, you can have options struck at different prices, right? So what about an option that gives someone the right to buy the stock at 500, right? What could I do with that? I already have the stock, right? If I'm happy to sell the stock at 500, I could sell a 500 strike call option to someone else who wants to buy it at 500 or wants the right to buy it at 500, and they're willing to pay me some money for that right, yeah? And if I'm comfortable saying, well, I own it at 440, if someone takes it off me at 500, I'll just bank 15%, right? So that might be a good proposition because not only am I earning some premium to give them that right, I don't mind getting rid of my stock up 15%. Yeah?
You still own the stock.
I own it here, but I won't own it above 500 because they're going to take it off me.
Yeah.
Right? So if I'm willing to give up the stock because I don't have, let's say I've got a view that in a month, this stock's not going above 500, right? Then I can say, okay, let me sell this call, sell a call option, strike 500. How much do I get? I get $1,500 for it. It's not bad, right? If you think about it as a percentage, if I own the stock, it's about 44 grand, right, of capital that I've put into the stock, right? That's nearly 4%, right? That's a little bit under 4% that I'm earning in a month, right? in a month, I'm getting given 4% on my money as long as the stock doesn't go above 500. And even if the stock goes above 500, I still make money because I bought it at 440 and I've just sold it to the buyer at 500 and I'm out.
But what the rest of the stock? You still get your 40p.
Well, when you sell the stock out of 500, you receive 100 shares. Every option is worth 100 shares.
Is it like if you were going to sell it, it's like kind of trying to make a bit of extra cash on the way out?
Well, the extra cash is that you receive a premium of the option, right? But you're only going to sell the stock if the option gets exercised, right? And the option is only going to get exercised if it goes above 500, right? So what you're saying is, well, the idea with options is that you're completely changing your risk profile, right? Because what you're saying is like, I could just own the stock and live and die with the fact that if it goes down, I'm going to lose a shitload of money. If it goes up, I'm going to make a shitload of money, right? Or I can say, I can have a more nuanced, I can have a more accurate like view and say, I own the stock, but if the stock rallies more than 15% in a month, I don't mind getting out. And then I'll just wait for the stock to come back down and buy it again, basically, right? But the beauty of that is that by having that view, I can earn a cheeky 1,500 while I wait, right? Because the stock might not go up there, right? If the stock goes down, if I didn't sell that call option, the stock went down, I'm going to lose money, right? I spent 40 grand, the stock goes down a few percent, I'm going to lose some money. So selling that call option also compensates me for if the stock goes down a little bit.
They use their premium.
Yeah, and I get to keep the 1,500, which cushions the blow. Right? It cushions the blow. If I zoom in a little bit here, right? This is what happens through time. The break even, if the stock drops to 428, 429, I'm not losing any money. Even though I'm long shares in 44 grand of capital, because I sold that option, I don't actually end up in a month's time. I don't actually lose any money until it goes below 3.5% because I collected that extra juice out of selling those calls. Yeah. So this is called call overwriting, right? This is the most common income generation strategy that the whole planet uses to sell options, basically, right? Because the whole planet is long a crap load of stock in the trillions of dollars, and they're passively long, like you guys do your index funds or whatever. You have asset managers, pension funds, all these guys sitting with billions of dollars of stock, and they're saying, how can we squeeze a bit of extra yield out of these stocks that we own? And they sell call options, basically, right? And they to punters like us who don't have a lot of money, who want to get some leverage for our capital, are willing to pay for those call options because we don't already own the shares. But all these guys are like, have those call options. We want the yield. You want the leverage. Everyone's happy, kind of thing. Yeah.
So it cushions your loss because
On the way down, it cushions your loss
you made
the premium.
the premium.
Yeah.
The buyer has now lost their premium,
Correct.
and you still have your stock.
Correct. Yeah.
So it's a win in that scenario.
It's not a win for the buyer.
Not win for the buyer, but it's a win for you because you still have your stock. You made it. Just the value of the stock has still gone down, but you're basically pushing the loss with.
Yeah, you just reduced the loss because you had some income off it, right? That's all. Right. You'll still lose if it goes down a lot, right? But you've been harvesting some yield out of it, basically, right? And the beauty is you could do that every month. Every month you can sell a new call, right? So stock goes down, you just sell a slightly lower strike call to get enough to get the same amount of juice every month, right? But you can have a target. You can say every month I'm going to sell whichever call option costs 3%. Yours, yeah, and you just keep doing that. And imagine we go through a period where the market does nothing for 6 months, and you've collected 3% every month. You're up like 18%, and the stock's gone nowhere, right? You're a hero, right? So that's the kind of stuff you can do with options, yeah. And this very much is the most common sort of simple option strategy that is used globally, yeah.
What's the premium about?
3% is just the premium, right? The amount of money you're collecting relative to the capital that you've got in the stock, right? If you've got 100 shares, that's a 44 grand capital. And if you're collecting about 1,500, that's about 3%.
In this.
3% of, yeah, exactly, in this scenario, yeah. So you can decide what it is. Maybe you want to sell the call that collects 1%. Maybe you want to be more conservative and have a call that's further away, that's even less likely to get exercised, right? But you can solve for that, what you're comfortable, right? Tesla's the kind of stock that can easily do 15% in a month. I mean, you can do it in a week, right? Which is why you're getting quite a lot of juice for that call, right? But you might say, okay, you know what? That's too close for comfort. Let me sell this one. What's this one worth? It's 2%. Still, it's still quite juicy, to be fair. That was like 1.5% or something. It's quite far away. Okay, but you could. That's what I'm saying. Like, you have an entire options chain to choose from. Right?
It was 60-40 to buy that option.
Yeah, the 560 call, right? Costs $640. Yeah, and the stock's trading at 440. So like, that's like a 30% out the money call. That's costing like 1.5%, right? So it's very expensive. Yeah. So again, that's a very attractive option to sell because it looks very unlikely that it's ever going to pay out, right? So if you're an owner of the stock, you want like a cheeky 1.5% over the next month of yield, and the only way you're going to lose your stock is if it blasts through 560, which is $120 away, which is like 25% away from here. I think you're probably quite safe, all right? Questions? Have I confused the hell out of you? Does it make sense?
I think this is into how to kick.
My phone should come here. So can you change the percentage? No.
What do you mean?
Like, someone thought he says 1.5 said no.
Well, I just did a rough calculation of what 6.5 divided by 4 is, right? But
Okay, change the
strike?
yeah,
Yeah, so what, you want it higher or lower?
higher.
So even higher.
Yeah, so we can increase our
That's reducing.
let's reduce it so that we can increase our potential gain.
Okay. So where do you want to put it to?
460.
460. Okay. So if you sold the 460, you'd receive 2,600 for that, right? But then the stock's already at 440, so you haven't got much room for comfort, right? Like if the stock goes up by like $17, which is like 3% or whatever, right? And you're already through strike.
So that would be a good deal to the buyer.
Yeah, because the buyer would probably exercise his right to buy, right?
Would you ever see that be something like that being sold?
Yeah, but it's a bit aggressive. Like it's probably too aggressive, right? You know, it's like you want, as a call overriner who's trying to earn income from their stock, you kind of want to keep the stock.
Yeah.
But ideally, you're long the stock because you like the stock, right? But you're saying, what can I sell that probably means I get to keep my stock, but I get a bit of extra juice?
So it's like gambling. You're basically like
It's not gambling. It's
not gambling, but it's like the risk of like it questions your temperament, because like, do I offer something that's achievable but that will still earn me a good amount of money, or do I kind of go for more money but risk losing my...
Yeah, but I mean, arguably, it depends how active a trader you are, right? So like, again, if you're passive, you may have no opinion, okay? But if you're like an active trader, and let's say you look at the chart on Tesla, right? And you look at the stock and you say to yourself, I know I've got a lot of lines on this. I've got so many lines on this. Okay. So like you look at the stock and you say, okay, well, what's realistically the upside in this stock in the next month? Like end of October takes you to there, okay? And we were saying 550 is up there, right? So like you can look at the context. The idea is you can look at the context of where that stock trades and how that stock trades and the type of moves that it has. And you can say to yourself, is it likely that by the 31st of October, which is the date here, is the stock going to break 550, right? It could do, but looking at how the stock trades, that's a big old move, right? So if you have an opinion that unlikely, you sell that call. And even if the stock explodes, chances are, look at what it did last time it exploded that much, that quickly. It came down pretty damn fast. So if you bought the stock here, right, and it went up there, and you got forced to sell it because the call buyer exercised their right and took it off you, yeah, chill a little bit, and the stock probably comes back and you can buy it back again.
Okay.
Right? So as long as you're willing to be a bit more active about your exposure and you don't mind getting taken out and then you can now be on the lookout for a chance to buy the dip again, it's amazing because you earn that income, basically. Right?
So even if you're forced to sell, you still will have something. And later it goes back down.
And that another way to earn income that we haven't talked about is called cash covered put selling. This is called covered call selling, what I just described, where you own the stock and you sell a call because that's the right to buy. Okay. Now let's say you didn't own the stock, right? But you wanted to own the stock. You know, you saw this breakout in Tesla. You believe in Elon and all the stuff he's doing in AI, and you think he's going to take over the world and he's going to own everything and the robo-taxi is going to be everywhere and all this stuff, okay? But the thing's just had a massive breakout from 340 to 440, okay? Decent move, right? It's like a 30% rip. You don't really want to buy it after a 30% rip because you think it's just going to correct a little bit, basically, right? Well, what you could do is you say, all right, where am I happy to buy this stock? Stock's at 440. Maybe I'm happy to buy it at 400. Is that fair to say? Would you buy it if you're a buyer of Tesla long term, but it's ripped and you don't want to buy it here? Where would you buy it? 400 in a little pullback? Yeah. So that's a 10% pullback from here, basically. If it has a 10% pullback from here, you're willing to get in. And let's assume you've got the cash to buy it. Let's assume you do have 40 grand available to buy it. Okay. Because you can't do this if you don't have the 40 grand available. Okay. But, you know, we're just giving an example, right? Other stocks that aren't as expensive as Tesla, you'll be able to do it if you've got a smaller account. But in this example, I've got 40 grand on the sideline. I want to buy 100 shares. And the reason we say 100 shares is because one option gives you the right for 100 shares. Okay. That's why we have to do 100 share minimums, basically. Okay. So if I'm going to buy the stock, I've got 40 grand parked in my account ready to buy the stock at 400. Okay. The beauty is I can basically sell a put option, and let's say I have no shares, right? 0. Okay, it's not letting me do that. Just remove. Okay. 400 puts, and that is what I'm going to do. I'm just going to sell the 400 puts, okay? And I'm going to collect $1,300, and they expire in October. So what does that mean? That means I get to earn, while I wait to buy my stock at 400, and I'm totally comfortable buying the stock at 400. I've got the money ready in my account waiting to buy the stock at 400. But while I wait, because it might not get there, right, I'm getting paid $1,300 over the course of the month. So I'm earning income. That 40 grand that I've got sitting there waiting to buy the stock, I'm earning $1,300 return on that 40 grand because that 40 grand is ready to buy the stock. If the stock dumps and I've sold someone this put option, what's going to happen? They're going to sell me the stock at 400. Yeah? When the stock dumps below 400, they're going to exercise their right to sell because they'd be stupid not to. Yeah? And you're going to receive the stock at 400, which you want to do anyway. But while you're waiting, you're collecting $1,300. Right?
What the need is? What's the premium?
But you're selling it. You collect the premium.
How they're selling?
Yeah. Right? So you
Risk them, sure.
your risk is the stock dumps to 300, but you don't care because you were going to buy it at 400 anyway, right? So as long as you've made peace with the idea, it's a long-term hold for me, but my entry point is not 440 where we are now. My entry point is 400, 10% lower than here. That's where I'm happy to put my stake in the ground, and I'll live and die by that purchase, yeah? And I won't panic if it goes to 300. Then happy days is the way to earn income on your money while you wait to buy the shares that you want anyway, right? So again, very common strategy called cash covered put selling, yeah? So we've got covered call writing or covered call selling, which is what we say when you're long the stock, you sell the calls at strikes where you don't mind getting taken out. And when you've got cash ready to buy stock, you can sell puts to say, well, I'm not ready to buy it here because it's just had a big rip, so I'll be patient. And the beauty is you're getting paid for your patience. Yeah?
He'll move it down to a lower put.
You can do, but you just get less money, right? So if you sell the 360, you're only going to get $500. So it's really about how aggressive do you want to be? What level are you willing to buy the shares and commit to buying the shares? And then depending on how close to the market that is, you're going to get more money for selling that put, basically.
So you would get less of the net credit, but you still potentially buy it at a lower, like how much?
Yeah, you can get in there at 360, but remember, there's a risk here, right? What if the stock never gets there, and you actually want the stock? What if the stock pulls back to 380, and then roofs it to the moon and goes to 800 in the future, right? You're going to be kicking yourself because not only did you receive less credit for selling the 360 put, right? So your income generation was less, and you didn't buy the stock that you liked. And then the stock rallied and you never got in, basically, right? So there's that trade-off. Yes, you can be opportunistic about how cheap you want to buy the stock. Might never get there.
Yeah.
Right? But it's a cool way to generate income, right? Which you probably never heard of.
So it encourages you to be more sensible with down higher. Not sell higher, buying low.
Well, no, I mean, it's just, you've just got to get comfortable with like how, watch how a stock trades, get a feel for a stock, and then assess the amount of risk you're willing to take or how much you're willing to put into the stock, right? Depends on how wealthy you are. It depends how much spare cash you've got to buy the stock. Like I say, this particular strategy is all about having enough cash to be able to buy the stock. If you don't have enough cash in your account and you get given all these shares on leverage, and it can blow up your account, and you don't want to be doing that, yeah? You want to make sure you do it in a way where you've got the stock, you've got the cash ready to own that stock. And that stock purchase is a long-term purchase you're willing to sit with. Yeah.
What do you call this again? You said the other one is
Cash covered put selling. So it's the two most common and the simplest income strategies in options: covered call selling, or covered call writing, some people call it. Don't ask me why. And cash covered put selling. Yeah, but they're great ways to earn a bit of income selling short-dated options. You don't want to go too long-dated. You want to go short-dated because they earn their premium quickly. Yeah.
Just assuming that you're not actually selling to like individuals, you say, you can sell it to someone. Surely there are actually people.
No, it's all an exchange, right? You trade all of these on an exchange. Like I'll show you this options chain here, right? So it's all on a screen. You have to basically get a brokerage account that allows you to trade options. Once you do that, you have a certain amount of money that you fund that account with, and then you get on one of these option chains, and you can buy or sell these options at the price that is available in the market, basically. So it's all electronic based trading. Yeah.
So what are these like people that are in the market?
Well, yeah. So as you can see, you've got bids and offers, right? So here you got bids and asks. So a bid, if I want to sell any of these options, I can sell them at that bid price. If I want to buy any of these options, I can buy them at that ask price. And there's a certain amount of size on those prices, right? So there's 0.9 of a contract on this is Bitcoin, so you can do fractional. There's 0.9 of a contract there on the bid versus there's 33.9 on the offer there, basically, right? So buyers and sellers all meet on an exchange and they put their prices and their orders in, and then you can transact with that, basically. That's how it works. Yeah.
So you said earlier on you said like one option is 100 stocks, right? Or shares.
Gives you access to 100 shares, yeah.
So in crypto, it can be lower.
Yeah, in crypto, it's not, the multiplier is not 100. It's like in Bitcoin, it's just one, right? So like one option gives you access to one Bitcoin. Yeah. But in US, the thing that trades the most, like in stock options, is the US listed options market, right? And everything in the US is on 100 multiplier. So if you trade one contract, it gives you access to 100 of the underlying, basically. Yeah. And that's like market wide in the US. Yeah. So we've talked about getting leverage, getting bang for your buck, because you haven't got a lot of capital, but you got a view and you want to multiply it. Problem with getting leverage is all that money could go to zero through that time decay. We could turn that on its head and we could earn that time decay to earn income via covered call selling or cash covered put selling. Okay. Now the last major way people use options is to hedge their risk. What the hell does that mean?
That's it, super.
No.
The time trading. Why time take?
So, what does hedging mean? Well, when someone says hedge your bets, what does that mean?
by spreading it out.
Spreading out, okay. So if I
Putting money on like, what if the opposite happened?
what if the opposite happens? Okay, yeah, I like that analogy. So if I'm long a stock like Tesla, might as well use the same example. Let me add the underlying back. All right, so I've got 100 shares of Tesla. Let's get rid of this option. Okay. So I've got 100 shares of Tesla. Okay. If the stock dumps to 360, which is like 20%, I'm going to lose like 10 grand. Let's say I don't want to lose 10 grand. Okay. How can I prevent myself losing 10 grand if the stock dumps 20% using an option? What could I maybe do? How can I spend a little bit of money to get some insurance in case it dumps?
You bulletproof. Buy and sell. Right?
Elaborate.
Like, you do a cash covered put sell and a
Well, no, but I can't put sell because I'm already long the stock.
Yeah.
If I sell a put, then I have to buy more stock. Can't do that. I'm trying to not lose money.
you do it to yourselves. Like
Yes, instead of selling it, I buy the put. Right? If I buy a put, then I'm spending some money to be able to get rid of my shares. Right? So if I buy the 400 put, which is 10% out of the money, that's going to cost me $1,300. But if it dumps to 20%, I'm only down 6 grand now, right? Whereas I was down 10 grand. Yeah. So am I willing to spend 1,300 to protect that downside scenario, basically? Right? That's the question. Yeah. So hedging is another major use of options, especially put options.
So you spent, so 4 grand, you saved yourself 4 grand of a loss.
If it dumps 20%.
But every you spent grand, so in there it's like 3.
Well, no, that P&L includes what I spent. Yeah. So that P&L is the total P&L, including premium and the loss in the stock. Yeah. So that includes the premium. I spent 1,300, and so I would have lost 10, but instead my net loss is only like 6 down there, basically. Okay. Yeah. But what if the stock goes nowhere? I still lose the 1,300, right? That's the cost of insurance, right? So again, options are like insurance. If you're buying them, so you're paying for insurance against a crash, yeah? The crash comes, you're glad you did it. The crash doesn't come, you still bleed the premium, yeah? So it's like peace of mind has a cost, right? So if you want to earn income from options, you're giving someone else the peace of mind, right? If you want the peace of mind, you're buying the options, and that's going to cost you money. Yeah? Starting to make sense?
Yeah.
Yeah, I mean, it's new, right? You're not expected to be an expert on day one.
what's it called there? Put any.
No, this is put buy. It's called a protective put. Look, up there. Protective put. Okay? Now, a little question for you. What if I thought that was expensive? What if I didn't want to spend 1,300, right? I thought it was a little bit too expensive to pay that, right? But I really need the protection because I think there's a risk that Tesla goes down. Is there anything that I could sell? Because I own the shares, remember? I own the shares. What have we learned about if we own the shares? What can we sell to bring in some extra money that can maybe help fund the protection that we're buying?
Sell the option.
Which option?
The option. Give us up a bit, right?
So what did we do earlier? What options were we selling when we owned the shares?
Call.
Call. So could we sell a call here? We own the shares. We're buying puts to protect the downside, but we can still sell the upside if we're willing to lose our stock, right? If we're willing to lose our stock at like 5, whatever it was, 520 or whatever it is, right? Let's add a call option sale. Sell a call at 520. That's going to bring in $1,100. Maybe we do it even at 500. That's going to bring in $1,400. There you go. If we do that trade, we lose the stock at 500. We own it here. So 15% higher, we're willing to lose it. But we're now protected for a crash. If it crashes, we're only going to lose 4 grand. And guess what we spent to do all of this? Nothing. We actually received $150, $140. Yeah. So we bought the put and sold the call together to protect the stock holding. Yeah. But so we've changed our risk profile, right? So instead of having a stock where we're just long the stock and we get killed on the downside or we make loads of money on the upside, we do this, which is called a risk reversal. That's the technical term for it, where we buy a protective put and we sell an upside call, just like we would in a covered call. Yeah. And net, instead of collecting the yield that we do in covered calls, we're spending that yield on protection. That's all we're doing, right? We're saying we're not selling that call for yield. We're just selling that call because we need peace of mind on the downside. And we're using the fact that, okay, if we get taken out of our stock, even though we didn't get any yield out of it, we still made 15% on stock because we bought the stock at 440 and we got taken out at 500. Make sense?
So you're at at each end.
Yeah. So that's a hedge. That's, again, a really, really common use of options, right? So we've got leverage, we've got income, we've got hedging. Those are like your three main reasons why you would ever use options. But they enable you to do so much more, right? Than just buying and selling stuff, right? You can now have very specific views about things. You can protect yourself against uncertainty, things like that. Yeah. What are we thinking?
Just trying to digest everything. You really feels a bit right.
Yeah, I think you need a break. I was going to suggest that.
Ben.
Why don't a lot of like forex traders sort of use options that I've never heard of options as option? And yeah, when I hear of like forex traders and stuff like that,
I mean,
never.
the professional forex traders who've done it for banks, they know what options are. The options market in FX is actually huge, but it's all done over the counter. So that means it's not exchange traded. It's like contracts between individual companies, basically, right? Okay. Like bank to bank, basically, right? So the listed exchange traded options market is much more in stocks and indices, basically, right? For some reason. I don't know why it's not so big in FX, right? But the most of the FX guys out there are just like cowboys, right? They're like kids who learn how to trade and they're like trying to sell a lifestyle, right? But they don't really understand the technicalities of trading, right? I mean, don't get me wrong, some of them might make money. I'm sure some of them do, yeah, right? But like, it's just, this is a level of trading that just enables you to trade multi-dimensionally, right? So rather than just buying or selling stuff because it's going up or down, this allows you to like cover a lot of different scenarios and allows you to have like views around timing, right? Because you pick expiries and stuff, right? So you can have very nuanced views about how something's going to behave between now and a certain date in the future, right? And it just opens up a whole can of worms, basically, right? And arguably a lot more risk, but also a lot less risk. Like, for example, this hedging structure I've just shown you basically has turned a Tesla position into something a lot less risky than it would otherwise be, right? So, and let's say, there's some event, like there's some announcement, like Tesla's about to launch like robo-taxis in like New York, and and there's a risk someone might get hit and then the stock tanks 20%. You might want to hedge that, right? So it allows you to do things like that. Yeah.
How long does it sort of take to learn like options trade?
I mean, that's like how long's a piece of string, right?
Yeah.
Because it depends on how much you do, right? Like, I mean, I've got people who do my online course and it's 13.5 hours of content. They study it in 2 weeks and then they get 3 months in my membership and they basically work and they ask questions and they study for 3 months and then they're actually quite proficient in 3 months, right? But I mean, I traded for 20 years, right? And I wouldn't say in 3 months of trading in a bank, I was proficient by any means, right? So it took me longer, right? This stuff, it doesn't happen overnight, right? But it's good to open yourself up to this world because it's a load of stuff that you didn't even know you could do, right? And what happens is every now and again, maybe once every 5 or 10 years, the shit hits the fan and the market does some crazy shit like COVID, right? Or 2008 or whatever, right? And if you see that coming and you talk to people in the know like me or whatever who have been in the game for long enough, my entire trading community will be getting ready for that sort of thing. and we'd be putting on hedges to protect our portfolios. And we would, if a 20-30% crash came, we probably swerved it quite nicely, right? So it's just like, but if you don't do the work to learn what these terms are and what this world is all about, you'll never be able to protect yourself for that, right? So I was having a good old time in COVID. The market was dumping 25-30% in a month. And it was so funny. I had my cousin living with me. She's a doctor. And she was like, how are you making so much money? All my friends are losing money and they're telling me it's the end of the world. And you're sitting there making 10 grand a day. And I'm like, yeah, because I know how to short the market. I know how to trade options, right? So that if you're in that small subset of the world, because it is a small subset, then it is game changing. Yeah, massively. All right, take a break. It's a lot of stuff.
For 400p.
Is your brain frazzled now? Can you take... All right, so you guys have got a comprehensive understanding now of what options are and pretty much the most common uses of them, okay? So remember, this presentation is not all encompassing, but it's to give you a flavor of the basic uses, common uses, and a bit of an understanding. Now, I also thought it'd be interesting to show you how deep the rabbit hole can go. And so how I use options. So I'm going to give you some recent examples of trades that I've done and why I've done them, so you can get a flavor of how like an actual seasoned professional does this stuff. Because the strategies that I've told you about so far are actually the most basic ones, right? Pretty much single options, buying or selling. There wasn't like lots of multiple legs on these options. So let me show you some of this crazy stuff you can do. So recent trades. So one type of trade that I do is a directional trade. Okay, so I've got a view on an asset. I'm either bullish or bearish. Bullish means I think it's going up. Bearish means I think it's going down. It might be for a number of reasons. It might be because I like the chart. It might be because I like the story, but I would have basically considered this asset and built a view about this asset. Okay. And then I would say to myself, okay, do I want to buy this asset for the long term in my long-term portfolio, like that passive investment portfolio that we talked about? Or do I want to use options to trade it a little bit more short-term and get a bit of leverage to my money, basically, right? So what I decided in this particular stock, and the stock I'm talking about is Circle. Do we know what Circle is? Circle is the stablecoin issuer for the stablecoin USDC. And the reason why I liked Circle, or the idea of buying Circle, was because, these stable coins are likely to get adopted over the long term, okay? And when this stock first got IPO'd, when it first launched, it launched somewhere down at $30 and it went to like $300 in like no time, okay? Because everyone was super excited about it. They wanted to get access to the story, the crypto future, all these things, and they just bought it like crazy. But now you can see how much of that has deflated, okay? It's come all the way back down to around 100, stabilizing at around 100. And the idea is that over the next 6 months, I think there's a very strong chance that this thing at least hits 200. It could go higher. But that as that story gains traction, as, all of these crypto rails get built, and banks get more involved and tokenize all these real world assets that they're talking about, I think it's generally going to be a good story for the likes of Circle, basically. Okay. So that's the thesis, right? So not only does the chart look like it's kind of based from that pullback that it's had, the chart's looking a bit healthier. It's showing that it's got a lot of upside if it gets anywhere near these highs that we saw early on. And then the fundamental story is quite intact. I'm saying to myself, okay, what kind of option trade could I do to get exposure to this? So based on what I've taught you so far, what might you be able to do to get a bullish position that will benefit from the market going up? What could you do? A call. So you could buy a call, basically, okay? Right. So let's have a think about a call that we could buy. So what I've actually done is I bought a call expiring in April, which is about 6 months in the future, 6 or 7 months, okay? But I didn't just buy a call. I bought one call at 150 strike, but I sold another call at 200. So this is what we call a call spread. Okay. So rather than just buying a call, which would give me that hockey stick payoff that I showed you, right? Where it just goes up in a straight line, as like if you had bought the stock, and it's got that flat line if it goes down. It's still got that flat line if it goes down, but if it goes up, I get capped out at 200 basically. Okay. So I'm not taking all of the upside that I could potentially take if Circle went to 300, 400, whatever, because I don't care for that upside. I'm playing what I think is a realistic view that the stock gets to 200 by April, right? And by selling this option, I paid 18 and a bit dollars for the 150 call, but I received $10 for that call. So for that call spread, I only paid about $8. Okay. So I paid $8, but if the stock ends up anywhere above 200, how much do I make? No, that's what I spent. I spent $8, $50. That's right, because I get all of the payout of the difference between 150 and 200, right? So so for an $8 spend, I could make $42 of profit, right? 50 minus what I spent. Okay. So that's a pretty decent risk reward, right? If you think about, that's 5x basically, right? I could spend 8 and make 42. It's a little bit better than 5x. If my view on Circle plays out and in April next year, we're above 200, then I've made 5x on my money, which is a pretty decent return, right? So that's one way I use.
You bought the option to buy at 200.
No, I bought the 150 call and I sold the 200 call. So I bought what we call a call spread. That's a call spread, right? So it's a spread between two calls. I buy one and I sell the higher one, yeah? So I want the stock to go higher, but I've sold that higher one to cheapen the cost, right? Because the 150 call itself was bloody expensive. It was like $18, which I didn't want to pay, right? So I said, I don't care for the upside above 200. I just think the stock probably gets to around 200, right? So how can I get a cheaper structure, but still make good money on the way up? And that's what this call spread allows me to do. Yeah. So that's one way. Yep.
Would you get in again at 200? Like after you've already sold it? Like would you buy it again at 200?
Well, the point here is I'm not actually going to sell the stock at 200. I'm just going to exit this call spread, right? So if the stock goes, and that's what these curves are really cool because they show you what you're going to make, right? So this call spread's currently worth, let's say it's worth about $8. But like if we project forward into time to February and we say that the price goes to 200 or even a bit higher, let's say 220, then I would be up $2,750, okay? So I could decide to just exit the whole trade, sell the 150 call and buy the 200 call back 2 months before the structure expires and just bank my money, right? I don't have to sit there and wait until expiry and wait to see if I was right and I picked the date perfectly and all that nonsense. I've just got a structure that will do well in a rally, that gives me time for the thing to play out, that gives me a good risk reward, that doesn't lose me too much money on the way down, and I can be patient with the view, basically. And if the view comes quick, if we rip to 250 in the next month, I ain't going to sit around. I'm going to take my money, right? Like, we rip to 250 in November, I'm up $2,500. Am I going to sit there waiting for the extra money in case the thing collapses again? Probably not. I'm going to take my money, right? But obviously, best case scenario is that it's a nice slow grind and I'm just chilling and it goes up and I'm up $4,000. But that's not really how these things play out. Generally, you put a structure on that looks good and makes sense. But if the money comes to you early, you usually take it, right? Any questions on that? All right, so that's one type of trade that I do, directional trades using multi-leg options like spreads, these sort of things. And there's all kinds of convoluted ways that you can do this, like with different options, but that's a fairly straightforward one where you buy one call and you sell one higher up. It's called a call spread. Now, the next thing I want to talk about is income trades that I do. So we talked about the simple income trades, which are basically cash covered puts selling and covered call selling. Now, there are income trades that you can do that are a bit more risky, and they're not based around whether you're long the stock already or whether there's a price that you'd be willing to buy the stock, okay? They are pure kind of short-term tactical trades based on your view that an asset's going nowhere in the near term, basically. Okay. So if we look at the S&P, for example, right? Biggest index in the US, it's the US market. It's what everyone looks at. And if we have a short-term chart on this thing, 15-minute chart, we get a feel for how this thing moves. Okay. So this is like what this thing's done over the last day or so. Okay. So pretty much from this morning, this thing was oscillating around 66.55 for many hours, right? It was like from 4:30 our time to, actually it wasn't that long. It was like a couple of hours, okay? So a couple of hours oscillating around 66.55, right? So let's just say for argument's sake, I thought the market was going to do nothing for a couple of hours, right? I could actually trade options to reflect that view, okay? And I could make money if I'm right, yeah? Now, if I'm wrong and it decides to have a massive move, I could also lose money, right? But if I've got, let's say I watch the price action very closely, I have a good feel for how this asset moves, and I'm seeing enough check marks and enough signs that this thing's going to do nothing for a while, right? Then there are trades that I can do to reflect that. And one of these trades that I can do is called an iron butterfly. Okay. It's got a funny name for a trade, I know, if you haven't heard of it. But basically, we bring it on here. It is a trade where you are basically playing for a range in the asset. Okay. And as that market stays in the range, you're going to earn time decay. Remember that thing, time decay, as these options decay away to zero. Okay. So if I bring this in here, so let's say for the next hour, I thought the market was going to do nothing on the S&P. Okay. Right now, the S&P is trading at around 66.75-ish. Okay. And if I did an option structure that was expiring in the next half an hour, okay, then let's see what happens to this thing. All right. So I could do this structure. So if I did this structure, I could earn $1,000, okay? And this is what the graph looks like. So I could earn $1,000 or I could lose $1,000, right? It's kind of like taking a bet. And the idea is that if the market just sits around where it is now, through the passage of time, see what happens to that green line. That green line starts to rise because the options that I've sold are decaying away to zero. Okay. And if they actually do end up at zero, which means the market ends up at 75, I could make $1,000 basically. Okay. So that's the idea. The idea is I'm taking a view that there's a range that this market's going to stay in. And if I'm right, then I've got some good money that I can make just through the passage of this market's going to shut in 33 minutes, right? So I can make this money in the next, 30 minutes. If I'm wrong, I'm definitely going to lose money, but the risk reward is I could lose $1,000 or I could make $1,000 basically. Okay. So that might be appealing to me. That might be something that I want to do, right? Another way of looking at it is, well, maybe I don't run it till the death, right? Maybe I just say, like in the last 10 minutes, I'm going to unwind it, right? So if I do this trade and I'm confident for whatever reason that we're going to stay in this 70-80 range, 66.70 to 66.80, I do this trade right now. I collect $1,000 from the trade. And then with 10 minutes to go before the market shuts, if the market's still sitting in this range, I close out the trade and make $500. I don't have to wait until the end of the day and see what crazy shit goes down because it's month end, quarter end. There might be loads of flows in the market that move the market, but they often save them right till the end of the day into the closing auction. Then maybe I just get out of Dodge and take my money, basically, right? So these are called intraday theta earning strategies. So there's a lot of jargon in that sentence, okay? The theta is another word for time decay, right? It's the Greek letter that we assign to time decay, okay? So these are all things that are taught in my online course that I do in options, right? Theta is the Greek letter that we assign to time decay. So every sort of risk that is embedded in options is given a Greek letter, right? So your directional risk on an option is called your delta. your time decay risk on an option is called your theta, right? And, you know, there's various other Greeks as well. I won't go into, yeah? But the idea is that this is a multi-leg option structure that allows me to be so specific about my view on the market that if I'm confident the market does not a lot in the next 2 hours, or not 2 hours now because it's going to close in half an hour, but I literally did one of these earlier, right? I did one of these an hour before I started this seminar. I closed it out just before we started and I banked $300 basically, right? Because the market didn't do a lot in that time, yeah? So once you start to learn how to do these can become your bread and butter go-to strategies where you've got time to watch the market. You understand how to risk manage these. You know how to structure them. Of course, they can go wrong, but you can cut them if they lose you $200-300, whatever it is. But if they go well, you can make $200-300, or you could even make longer if you run them till later in the day if you have a very strong opinion, basically, right? But the idea is that there's these income strategies that you can do that are completely independent of your long-term stuff, like your stock holdings, but they are very specific to an asset, a liquid asset like the S&P. You could do this on the NASDAQ as well. You could do this on other indices, but the S&P tends to be where most of this stuff happens. You could do this on Bitcoin, right? Some people do this on Bitcoin. They do one-day option selling on Bitcoin to try and make theta, to make time decay as well. So, but anyway, this is a big part of the market. There's tons of people doing this in the US. Probably not a lot of people doing this in the UK, but it is a very growing part of the market, and it is one of the ways that retail traders make money trading options, basically. Yeah. Thoughts on that? Yeah. Ever heard of an iron butterfly? Well, there you go. Definitely learned something new today. All right. And then the last thing I wanted to show you was, so apart from these very short-dated income earning trades, directional trades to reflect my views on things, hedging my stock positions is a big, big reason why I use options, okay? So sometimes I'll have a stock holding. I'll give you an example of a stock that I've been long for a while, okay? It's a miner. It's a copper miner called Freeport-McMoRan, okay? And if we zoom out on this, you know, I bought this stock, God knows, a long time ago, okay? So you can see long-term chart on this, it's done pretty well, okay? But I don't actually remember exactly when I bought it, but let's say I bought it somewhere down there, okay? So I've done pretty well on this stock over the years. It was based on just generally liking copper as an asset. It was about the electrification of the world, needing a lot of copper globally. So thinking that copper prices would go up, so copper miners would do well, basically, okay? So I own this stock, and what I do is I track the copper price relative to this stock. So if the copper price goes up, I would expect this stock to go up. Vice versa, if the copper price goes down, I'd expect it to go down. And what happened is we had this craziness in copper where Trump whacked 50% tariffs on copper. Copper spiked crazy. And then he turned around and said, oh, you know what, actually it's only for a certain type of copper. It's not for this refined copper or whatever. And then then copper crashed again. Okay. So then copper crashed again, but then Freeport rallied back to its highs. So Freeport here got back up to 46, 47. So when Freeport was here and the copper price was down, I was like, okay, there's a dislocation here. I own this stock. I'm happy that it's rallied, but it doesn't make sense that it's rallied while the copper price is still down there. Okay. So I was like, maybe I should hedge some of my stock, because if the stock catches up with the copper price, it's going to drop, basically, right? So then I did this trade where I remember those risk reversals I told you about. So I did this trade where I bought the 44 puts. I sold the 50 calls. That was the risk reversal. Okay. But then I bought some 55 calls behind it. And then I also sold some 40 puts behind that one. So it was it's kind of like a capped risk reversal, basically, that I did. Okay. But the idea was that if the stock dropped down to 40 from 46, I would make some money, basically, right? And if the stock rallied above 50, I'd be happy to let go of some of my shares, basically. Okay. Because I'd own the shares forever. They were up good money and stock looked expensive up here anyways. I was like, you know what? If they want to rip this stock to 50, I'll let you have some and then I'll wait to buy a dip, right? But if the stock drops, I get some money coming my way, right? Now, as it turned out, the stock dumped 20% last week. But the only reason that was not because the copper price dumped, but it was because they had a shocker with a mine in Indonesia that they had to shut down, and it's going to affect their margins and things like that. So the stock had a repricing lower. But obviously, I own the stock in my long-term portfolio. So I was like, I'm going to take a drawdown. I'm going to take a loss in my stock holding, but at least this option position is going to pay me, right? So then I closed out the option position last week and I made $1,700 on the option position, basically. So that absorbed some of the loss that I took on the stock. I'm still long the stock. I'm still happy with my view on copper over the long term, but it's nice because this option trade that cost me zero basically paid me a cheeky little check of $1,700 whilst the stock pulled back. And now I can just sit tight and wait for the stock to do its thing because I'm still a long-term bull on copper, right? So that's how in real life you can do these hedges against stocks that you own for the long term. And then if you get lucky or if an event happens that takes the stock down, you then monetize those hedges because that's the reason why you put them on to actually make money out of them in a pullback. And then you go back to your naked long position, which is the stock position you had anyway, and you've absorbed some of that loss, basically. All right. So that's what I did on Freeport.
What was your put loss in that? Bit?
So I was long the put, right? So I bought the 44 put and I sold the 40 put. So my gain was capped. I could only make that $4 between them. Right. So if I didn't have that put, if I didn't sell that 40 put and the stock dumped to 36 like it did, I would have made even more money. I would have made another $4 on 5. I would have made another $2,000. So I would have ended up making nearly $4,000.
If
right?
you didn't, you would have lost the premium that you paid for that.
Well, I would have ended up paying more premium, right? So it was annoying because initially I didn't sell that 40 put. I didn't initially sell it. I just bought the 44 put. I didn't have any shorts down there. I sold that call spread. But what happened was literally the day after I did this trade, the stock dumped 6%, right? I was like, oh my God, it's dumped 6%. And I thought it's probably going to bounce. So I'm going to sell this 40 put out, right? And if it bounces, look at what I sold the 40 put for. I sold the 40 put for 60 cents, okay? Right? So I was like, I'll sell the 40 put. If it bounces, I'll buy the 40 put back. And I would have just nicked a bit of money, basically, right? Okay. So I was being cute. I was trading around. That's called trading around your position. I was being a little bit too cute there, right? Now, had I not bothered selling the 40 put, as it transpired, 3 weeks later, I would have made like a crap load of money. Okay. But unfortunately, I didn't buy back the 40 put like I wanted to because it didn't get cheap enough. I sold it for 60 cents. I was going to buy it back at like under 20 cents. Right. And I would have that's called scalping. I would have scalped a little bit of money out of that put and I would still have my protection on. Right. But I was like, you know what? If it dumps early, so be it. I'll still make $4 between those strikes. So I'll still make $2,000 or close to $2,000. That's fine. Right. I didn't really think it would dump to 36. I didn't know what the news flow was going to be, basically. Right. So in an ideal world, I wouldn't have sold that 40 put. But because the market dumped so quickly the next day, I took it as a bit of a gift that I could scalp that 40 put. Yeah. I could monetize that 40 put, reduce the cost of my hedge even more so that I spent zero on it. Right. And that's how it ended up playing out. So sometimes being too active and being too professional at this stuff can actually work against you. Because like someone more novice might have basically said, yeah, I don't want to overtrade this thing. Right. I've got my trade on. I'm just going to leave it and see how it goes. That person would have made $2,000 more than me, basically. Right. So you can sometimes, by over trading and being too opportunistic, you can mess yourself up. Like it was basically this drop here. Let me zoom in on this thing. I entered the trade on that day, right? And then the next day it dumped 6% to there, right? So I was like, you know what? I'm going to sell that put. And then it rallied, but I was too slow to buy it back. So I would have had the option. 2 days later, I would have been able to buy it back, but I didn't manage to buy it back.
At 40.
Yeah, I would have bought the 40 back and got back to my original position. But this is the problem. Like, if you're doing these sort of trades, you've got to be really on it, and you've got to be quick to take your money. And I was a little bit, I mean, it wasn't there for long, basically, so I didn't squeeze enough out of it to unwind it. But you know, that's life, right? That's part of the game. So, but anyway, like I say, for me, making the $4 between 44 and 40 was enough protection. It was still like $1,700 that I wasn't going to have otherwise if I hadn't done this. So I was happy with that. Yeah. Make sense?
Where did the 17 member? Is it for?
Well, the payout between these two, and the fact that it wasn't at expiry yet. If I had run it all the way to expiry and we had stayed below 40, then I would have made $2,000, because 5 times 100, so 500 shares times $4 is $2,000, right? So I would have made $2,000, but because I unwound it early, because I wanted to just bank the money, by taking it off early, I didn't capture the entire profit, basically, right? So that's why I made $1,700 instead of $2,000. But you don't need to worry about why I made $1,700. You just need to understand the concept that I hedged my long stock, and the stock pretty much did exactly what I was concerned about. And then I was able to unwind these options for a healthy profit, basically. And I spent no premium to do that. All I did was give someone the chance to take the stock away from me at 50, basically, right? But I owned the stock anyway, so that was cool. Yeah? So that's the thing. When, for example, like whenever you own an asset and you've done really well and it feels very, very overbought, right? Overbought means just it's gone parabolic and it's like it's so due a pullback, right? That's when you can look to do these sort of trades where you sell a call option, you buy some protection, and you just wait for a pullback. If the pullback never comes, you don't lose anything, right? If the thing keeps going parabolic, you've made peace with the idea that you'll sell some of your holding, right? But if the pullback comes, you unwind it and you bank some money, basically. Yeah. So those are the few little bit of insight into trades that I've done. Now, not every trade I do in options makes money. I'm not claiming that, right? Anyone who claims that is full of shit. Okay. So, but the point is, there's logic to why I do these things. There's certain types of trades that I do that fit my lifestyle, that fit the way I like to trade. And it's a whole rabbit hole to go down, basically. Right? And if you wanted to go down that rabbit hole, then Options Insight's the place to do it, basically. Right? So, you know, like I say, there's no easy money in this. Anyone on Instagram, whatever, is telling you that trading's easy and think it's a get-rich-quick scheme, utter nonsense, right? But with dedication, you build the skill, you take your time, you practice with paper trading, you learn these skills, you do it with a community of other traders who are also learning and asking, and you have someone like me who's done it for 25 years to answer your questions, then you might have a chance, basically, right? So we've got a group, we call it the Alpha Pod. It's a Discord group. I've got over 100 people. A lot of them are US-based, trading US assets. But I want more UK people, right? I want more people in the UK to wake up to this instrument that is available for us to make money out of, right? If we're willing to put in the work, or if you guys are willing to. I've already put in 25 years of work. And then always start small, get educated, paper trade, gain confidence. And don't risk money that you can't afford to lose, and start small, basically. Yeah. But Options Insight is always here to help and answer any questions. And that's it. Thanks for coming. Hope you found it useful. Yeah. Brain would be fried, yeah. I'd expect that. Means I've done my job. Yeah.
I have a question.
Go for it.
Just out of curiosity, what is the one biggest mistake in a trade that you've made?
That I've made?
Yeah.
Well, if I go back to my banking days, I had a really bad year in 2010, right? Probably the worst year of my career. And I think the biggest error that I made was underestimating liquidity. So what that means is you think you're going to be able to get out of a position when it goes wrong, right? But when the market starts moving, suddenly there's no sensible price to get out, basically, right? So that's the risk. The risk is you got to trade when you take big risk, or if it's big risk for you, basically, but it's only a bank, it was monster size risk, right? When you take big risk, you need to make sure that when it goes wrong, you'll be able to get out. And if you're too big that you won't be able to get out, then that's liquidity risk that's not worth taking, basically, right? That could blow up your whole year, basically, right? And that is kind of what happened in 2010. Thankfully, I'd had a good couple of years before that, so I survived. But it was just, that was a bit of a lesson.
How about your personal?
I wouldn't say it's like I haven't made any disastrous mistakes. I would say, just having a directional view, but going too short dated. That's quite a big mistake that a lot of people make, and I've definitely made it before as well. It's like, because the worst feeling in the world is where you were right, but you made no money, right? And the reason why you made no money is you went too short dated on the option, right? So, yeah, I always say, always add a bit of extra time to the option to give yourself some wiggle room on not getting your timing perfect, basically, right? Yeah, that's how I'd say to avoid those outcomes. Yeah, because trading's hard enough as it is, but when you're right about something, you still don't make money. That's the worst feeling ever, right? Anything else? Call it a day? All right, let's do it. It's 45 minutes over anyway. So. All right, cool. Cheers, guys.